Still talking about the levels. Intraday, the dealer's going to make 3 pushes, or I had to say it. The DMR uses a little different, so I want to try to use their terminology. I guess 3 price bursts or pushes during the day, and then what they'll do is they'll hit the stops, drop. In this example, hit the stops, drop. At the bottom or top of any cycle, what I want you to start to notice is that the dealer will set up his trap move. He'll turn the pins to the downside, or his trap move will be an outside structure or some type of aggressive vector move towards the low or towards the high. The pins will become unidirectional at the extremes. The pins will point in the direction that he is setting the trap. So if you notice the pins are to the high side, the dealer is trapping high. Because what he's doing in essence is running the candle all the way up and then pulling it back down and closing on a pin. And what's left is the footprint of the damage that he has created in the form of a pin. Okay? Market makers will not move one direction more than 3 days in a row or 3 sessions in a row. I mentioned to you that the third session is corrective in nature against the trend. Okay? We've illustrated their cycle, talking about the intraday stuff. I'm going to break it down for you one more time. We'll go over a few more things. We'll look at some charts, and then we will be wrapping it up for today. So, market makers use a lot of structures to earn profit, but their intraday cycle and the drawing that I've made for you is set up like this. I'm going to point out some things that I couldn't draw. During initial market hours, market makers set the high and low, the initial high, initial low. They then trade within that range for people to build positions, not allowing any traders to take an exit by not showing you much more than 10, 15, 20 pips. I told you the ideal range is 50, but a lot of times that range will come in 35, 28. The range comes in tight and you try to trade during the Asian range, there is no room for you to book a profit. So by keeping that range tight, the dealer has in essence landlocked you or locked you into a position whether you realize it or not. Because you think you saw something that was good, you take the position during Asian session and it never really goes into profit, but you believe and you're convicted in what you saw and you sit with that position and you drag it through into the next session and it turns into a disaster. Them not allowing you to take an exit is on purpose. If you notice before non-farm payroll, the dealers get into a tight range. Any big news release, the dealers get into a tight range. They accumulate volume high and low, bring it in, tighten it up, hold the range very close, and then punish that range on the release of the news. Before, I mentioned you around 1 to 2 a.m., they will widen the swing right before the European session, which is the end of the Asian session. Prior to gap time, they will expand the swing or widen the swing. They do this for the breakout traders. For the people that like to trade breaks of the Asian session, that's their counter for that. You think you got a great breakout system? Their counter is they expand the swing and pick up those orders, pending or market. At the start of the European session, they're going to severely correct or rise against their real intentions. Stop, hunt, vector. Okay? So at the start of the session, what time's the start of the session? 3:30. They're going to severely correct or rise against what is real. That is what is known as the momentum candle. That is our vector candle. Okay? The severe correction or rise extends the initial high or initial low of the day. Okay? The drop or rise triggers all the stops of the weaker retail traders that use textbook stops like 5 pips above or below your candle, just on the other side of the Asian range. All those weak stop loss placements. They then quickly go into consolidation, which is the aggressive move of the M&W forming at the high or at the low. This builds positions to further strengthen their book. They will then hit the stops one more time of all the lower level or higher level traders. This is where the second leg comes into play. They don't always hit the stops one more time. If during the accumulation phase, if during the second accumulation phase at the high or low, right? Okay, here's what I told you so far. They set the initial market hours. Okay? They chop back and forth. They widen the swing to pick out the breakout traders. They correct aggressively, which forms the vector. They pull back and go into another consolidation. This segment, consolidation accumulation, is the same thing. It's a smaller version of it. It's a period of collecting contracts against the traders, building their position or their book against the retail people that are trading. Okay, so depending on how it has set itself, they may hit the stops one more time. That gives you a second leg. They will not always hit the stops a second time. This is where we call our outside structure. And I'll talk about that some more. Half a Batman. The quick action leaves everybody stunned. Like, oh my goodness, I'm stopped out. What do I do? I'm sitting there, right? And then before you can re-enter or make up your mind, they hit the stops and then they shift the zone aggressively and they get the hell out of there. One bar. That's the bar. The shifting of the zone is a bar that puts our group into profit and everybody else into agony. How many times have you been in a trade, blinked your eyes, and you're down 25, 30 pips? That ends today. Okay? No more taking trades in the middle of the range against the shift bar in line with the retail stuff, not the dealer stuff. It ends today. When you see the shift bar, that is the signal that your trade will work out today. Answer on one of your questions. Okay? When they shift the zone, they trap the remaining lower level or higher level position holders, and they are there for the cycle. They either get stopped out, or they lift their stop and get drugged backwards for the rest of the session. Okay? That's how it works. Now let's put it to a picture. They saw something down there, maybe some breakout orders they had to grab. Okay? An aggressive move towards the low, they hit it. They go into accumulation here. They're accumulating contracts. They come down here and they hit the stops one more time. Right here. Remember the picture of the money grab I showed you? That's exactly what they're doing. They're reaching their hand below that level by opening the spread and grabbing whatever orders are sitting there. Okay? And then what do? They shift the zone. In this bar, they happen to do it all in one. In this example, they did it all in one bar. But how long does this accumulation phase go on for? Man, I told you 30 to 90 minutes up to 2 hours. This is longer than that. 1, 2, 3, 4, 5, 6, 7, 8, 2 hours, 9, 10, 11, 12, 3 hours. About a 4-hour consolidation period. They held the low at London. And if you notice, there's Blueberry right there. They faked past the 4-hour signal and had a lot of people on the higher time frame piling on short. So the going was good. They hung around. Collected those orders for 4 hours. Anybody that got long prior to the spike and stop hunt was taken out in one swipe. So you had a position, you sat in here. If you were long and you saw this, the dealer made certain, because if you entered long in here, your stop loss guaranteed was in here. How do you know, Steve? Because the dealer came back and made you pay, took you out, and then went in your direction anyway. Right? Okay, so then off to the races, into consolidation to end the day. This is exactly what I just explained to you in a picture. Okay, we're going to move on to the level. So, everybody feeling good? Understand the pattern? Understand how the dealer lays it out every day? The dealer has 3 levels of rise. The dealer cycle. The age and range, ideal age and range is 50 pips or less. On average, it's about 35, 40 pips. 28 could be the range. Okay, good. Some people saying you got it. Yep, good. Okay. Right? You understand that on our template that these are the stop hunt zones. Right? There is a map of this in your student folder. It's a stop hunt zone. You understand this is the brink shadow. This is the brink shadow. The brink shadow needs to encompass the 3:45 and 9:45 candle. Okay, depending on how your chart snaps and sets up, that shadow box should start from 3 and end at 4, and should start from 9 and end at 10. But it needs to encompass the Brinks candle, and you need to know where on your dealer that Brinks candle is. You need to know that this ends at 1 a.m. And then you count 1, 2, 3, 4, 2 a.m. 1, 2, 3, 4, 3 a.m. You understand? Same thing here. You need to map your dealer exactly in line with the template that's provided in the student folder. Okay? And a lot of you having problems with this. That's why Ray is working on a fix for it. It will be posted. Okay? All right, the count. The count is understanding the levels. Okay, some people are still asking about the Brinks and mapping. I'm going to cover it again. I go over the boxes, but we're working on a fix for everyone. I'll talk about it again. Don't worry. I don't want to get distracted right now. The count. The count is based on trader psychology. Fear, greed, and inexperience are used to prey upon the traders by the dealer. It's based on the thing I talked about earlier, the number 3, the psychology behind the number 3. That people need to see things because they're stubborn a couple of times, 3 times, the 3rd time's the charm. Think about society, how it's set up. Oh, things come in 3s. If 2 people died, I'm expecting someone else. Think about the sayings that people say. If you see something for a 3rd time, you start to believe it and fall for it. That's why the dealers base their structure on the number 3. Understand that there's an intraday count and there's counts over several days. They are all used as trap moves to grab your equity. Okay? The dealer shows you something. He makes you believe it. And if you don't believe it, that's a good one, Paul. If you don't believe it, he'll show you some more until you fall for it. What do I mean? I mentioned to you earlier about extended stop hunts. Okay, what happens? The dealer will rise to a point on the chart or fall to a point on the chart and do this. 3 moves and go into consolidation, right? He's sitting there for a while. How long is the time constraint? 2 hours. If the dealer doesn't correct within 2 hours something else is going on. Remember I showed you he held the level for a while? Okay, he can be A, handling the crosses, B, collecting more to balance his book, or C, going to make a higher stop hunt or induce more traders to go long. So what does he do? He will extend the level to the next 25 to 50 pip strike zone. So in essence, what he's saying to you is, oh, you don't think it's going to go long? I'll show you long. And he rises price to the next level. And then he will make the structure and correct. So if you see the 3 pushes, consolidation, and you don't believe that it's long, and the dealer's book does not reflect what he needs long, he'll show you long. And when he shows you long and you bite, when enough of you bite, he corrects the market and takes it back. Okay. Understanding the count, which is known as knowing what level you're in, will virtually eliminate all your technical analysis study. Hope you guys are glad to hear that. Like, oh man, I don't have to draw any lines anymore. No, you don't. If you could identify the dealer cycle and where he is and what his behavior is, you don't need to spend hours in front of the screen drawing fibs and support and resistance and blah, blah, blah. I can go on all night. So much that it'll make you puke, right? Once you master this, you can walk up to any chart, observe the dealer's behavior at the appropriate time, and know his next move. Understand. What do I mean? Steve, what will the euro do tonight? Helen, I don't know. But I'll tell you at 3:30, 4 o'clock if he forms the high first or the low first. I'll tell you if he breaks the psychological support barrier to the downside and anchors, I got him. If he breaks high above psychological resistance and forms an M, he's going to correct. Once you understand that you are reactive to the dealer's actions, then your time in front of the screen will be minimized. All the technical garbage you've been analyzing will just fade away. Not necessary to draw lines. Now, did I say you don't have to do any work? No, you have to master this. You have to do your R&D and your homework to master this. But once you understand how the patterns present and when they present, that's your technical study. Your technical study is you walk up to the screen, you see that the dealer has made a peak formation low on Tuesday. I expect him to trade stop hunt low rise, stop hunt low rise, stop hunt pin high drop. That's the cycle. Now I know the cycle, so where's my technical work? I come in around 1 o'clock in the morning, I hang out till about 4 or 5 o'clock and wait for the dealer to give me a stop hunt low rise. If he doesn't give it to me, I don't have a trade. Wednesday, same thing, stop hunt low rise, I hang out. Thursday going into Friday, I expect the dealer to trap to the high side, grab the traders on a 333 maybe, pin to the high, hit the stops, and correct back into the range to end the day and the week. Remember, end the day in consolidation, end the week off of the high Friday trap, back in consolidation, mid-level. That's how those technicals are eliminated, because you understand the dealer cycle. You can walk up to any chart at any time and analyze where the dealer is without hours and hours of technicals. Now understand, I have hours and hours of R&D and hours of screen time to get to where I can walk up and say, this is what he's going to do next. My goal and dream for all of you is to get yourself into that position. Okay? Do not associate the levels with Elliott wave or any other indicator, the zigzag coordinator, whatever the hell you're using. It's not the same thing. Market makers form zones or levels to trap the traders, book profits, and hit the stops. Sometimes it's crystal clear, easy to see. You're like, it looks like stairs. It's like, oh my goodness, can that even be real? Sometimes it's a little more difficult because you'll have a level of rise, you might have a chop, and then it'll continue. It might appear to go on for 4 days, but in reality what's happened is the dealer has made his anchor, went up, chopped here, maybe this is Monday, this is Tuesday, and then he'll extend this through Wednesday, and then he'll continue Thursday and Friday. So you'd be like, Steve, that's 4 days. Yes, but there was no rise here. Okay? Remember, always at level 3, you will see aggressive moves. Risk appetite has entered the market. Momentum is in there. Level 3 is the dealer's area where he books and goes heavy. The dealer is in on aggregate. Okay, the dealer is not all in at individual positions. He's on aggregate because he's making the market all the way, right? Making the market, making the market, making the market. So what is he doing? People are buying, he's selling. People are buying, he's selling. Now, the dealer is averaged in here. If you know anything about averaging in order for the dealer to make a profit, he has to come heavy at the highest peak formation. So let's say that he has $100 million on aggregate rolling up, then he needs to have $100 million at the peak, or $150 million or $200 million at the peak. And then upon correction, he will come out in a winning position. Because on aggregate, a third to mid-level correction will cancel out all the orders that are averaged up. Okay? So the dealer will book a profit and end the day back in consolidation. And whatever aggregate was left on the board, he reconsolidates and evaluates those numbers and starts the day tomorrow with some volume open trapped. Okay? All right. There are 3 levels of correction or rise over 3 days. 2.5, 4.25, yes. But textbook, 3 days. The first level of the correction is market driven by the market maker. He creates the panic. He vectors the candles. He creates that flash. It's the fast move, the V3 that we're talking about. The second level of correction or rise is driven absent of the market maker. It's where the emotions of the traders kick in and they go, oh, I'm missing it. I want to get that. I wish I would have got in. Yada, yada, yada. They jump in. He watches their behavior, analyzes the book, and takes action based on the reaction of the traders. Remember I told you need to react from the dealer behavior? The dealer reacts to the emotions of the retail traders. You are not going to react to the emotion of the retail traders. It's a sucker's trap. You are going to react to how the dealer handles the reactions of the retail traders. So you're reacting to the reaction of the reactor. All right, you got all that? It's an over-exaggeration, but what you're doing is he creates something on the chart, first level correction or rise. He steps aside for the second level to form. He watches what the retail traders do and analyzes his book. What you do is you watch what he does. And then you react to him. The third level correction or rise is market maker driven to trigger the stops and create more panic within the marketplace. During these levels, market makers will buy from the traders to create positions. They're always buying. They're either selling to you or buying from you. And you know how it goes. If you buy pounds, sell dollars, or sell dollars, same stuff. They're buying from you. They're collecting. What I just mentioned, the heaviest volume will be seen at level 3. Because at level 3, they are extended themselves over an aggregate. They must correct or rise the market to get back to where they need to be. Okay? That's why level 3 is choppy. They're hitting the stops and they're collecting contracts and they're trying to confuse the traders on which way they should take their positions. Okay. An oversimplification. When the signal appears, simply buy or sell third level rises and third level corrections. If you can count to 3, profit is going to be realized in your trades. It's an oversimplification, but I want you to understand. Chasing the wrong segment of the market is not going to make you successful. It's when the pattern appears in level 3. Now, 2 traders that have turned the corner recently, I don't know if it's all right to say their names, but one gentleman was 5 for 5 last week. He's a pharmacist in Tampa. He's a good friend of mine. I'm proud of him. What happened was he was struggling. He didn't understand what I just put up here. Waiting for the pair to be in the proper segment of the cycle will guarantee your results. Now, I know in the Forex business you can't say guarantee. You can't say that. NFA is going to come over here and slap the handcuffs on me. I'm telling you that if you trade like a dealer and deal in level 1 and level 3, when the patterns present themselves and take second legs, that you're going to be 5 for 5, 7 for 7 for the week. I know you only know me for a day and you want to call horse shit on me, but my students are doing it. It's doable. It's not enough that I can do it. It's got to be enough that I could teach someone else to do it, not just one other fluke guy. Dozens of students are going 5 for 5, 8 for 8. Casey from Compass, Kim's daughter, she had a month where she didn't take any losses. Have you ever heard of that in the business before? You ever heard of anybody go 15 for 15 or 15 for 16 in the business? Luther and Kerr, 10 for 12. It requires you to understand and to open your mind and practice and commit yourself to what I'm teaching. It is doable. Vesubio is another one with big numbers. Okay? When I say this about if you can count, profit will be realized, it's kind of a joke, but it's kind of not a joke. Because here's what I mean. If you could identify this part of the cycle, and then the 3 intraday pushes in this part of the cycle, your job is to deal from here and from here. The rest of this is for advanced. But I'd like you to stay out of that. It's not necessary. This is where the safest part of the structure is. Why? Because the dealer's made the high of the day. Your stop goes outside of his reach, and it goes outside of his reach down here. Why? Because here's why. The dealer is not going to move a $4 trillion market back to get Ted. Ted, I don't know if you're in here or not, buddy. But he's not coming back, baby. Lou. Okay? So if you learn to deal at the extremes, at level 1 and level 3, third level of the correction, third level of the rise, level 3 becomes level 1, you learn to deal in these regions. You will have success in the business. All right? In addition to each of the 3 levels, there is a corresponding level of consolidation. Now, here's what they do with this consolidation. They create false support and resistance points on the chart for people to draw lines on, almost as if it's a joke. Most of the time, the stops will be triggered before the next level is started. During these zones, 20 to 30 pip swings will be seen. Market makers are trying to hit the stops both ways to make easy work of the next level move. No buying or selling pressure from the traders because they've scooped it up and taken it off the board. So if they pocket the volume they can flash the market and make it move how they want with less resistance. And I don't mean like support and resistance. I mean buying or selling pressure is the best way to explain it. Okay, so here's what I mean. Dealers hit the high 3 times. London opening hits it. Hammers issued. Level 1, correction. Hit the stops, bring it in, bring it in, bring it in, drop. Level 2. Absent of market maker support, level 2 is usually smaller. Level 1, aggressive move to make you turn the corner and think something's going on. Level 2, absent of market maker support. Level 3, the pins will change direction. Will change direction as a trap move to the downside. So you have hit the stops high trap, pins to the upside, pins trap high. See the pins trapping high? Correct. Hit the stops drop. Hit the stops, correct. Turn the pins unidirectionally and rise the market back into the range against the retail trader's downtrend. Understand? Okay? One, consolidate, hit the stops, 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 drop. Bring it in, hit the stops, drop. Trap to the downside, back into the range. Level 2, level 3. Okay? 3 intraday pushes. If it lays out like stairs and you go short right here, I'm going to kill you. If it lays out like that and you go short at the bottom, shame on you. That is an absolute reversal point on the chart. The dealer has hit the stops high, corrected, brought it in, held the level, hit the stops in both directions, drop, hit the stops, trap, hit them again one more time, and correct. He then establishes the low of the day and trades off that number to end the day back in consolidation as the 50 EMA is the target. And he goes right to it. Okay? All right. Another one. This is where you had a very tight day. Perhaps there was nothing going on this Monday. There was no options or expire or whatever the reason was. There was no interest in trading euro. So here's what the dealer did. He made his peak formation here. He corrected, ended the day in consolidation, nothing going on. You could project where the next consolidation zone will come in. Okay? Pins to the mayonnaise. Confirmed entry. Confirmed entries are, I'll talk about them, but when you get the crossover on the mustard. Okay? The dealer corrects for 2 levels the next day. He corrected 1 level on Tuesday, and then he corrected 2 more levels on Wednesday. So what happened was you had level 1. In essence, you had a safety trade. The dealer corrects 2, 3. He starts to show a head and shoulders type behavior. You're looking for buys now back into the range. Okay? Remember I told you the levels could be 2.5, 3 days, 4 days, but as a textbook it would be 3 days over 3 levels. Now, don't confuse a couple of days with the intraday stuff too. You could have intraday 3 pushes. We can make the argument that this breaks up into 3 levels. 3 pushes intraday, right? That would be a 33 trade. 3 pushes on the last leg of the run. It's not a good example of one, but we'll get one. Okay? Peak formation is formed on Friday. the LOW, the low of the week. The lowest point on the chart from Friday. You identify it. The dealer comes out and does not trade below the psychological support and resistance level. What do we expect the dealer to do coming out of level 1 consolidation? The straightaway trade. The straightaway trade, by definition, is a trade where the dealer does not trade below or above the blue box and issue you a visible stop hunt. The straightaway trade is when the dealer does not make a visible stop hunt below or above the blue box. And he does not do that. But the clues are here. Remember I told you sometimes when he's consolidating, he'll shift it up. Well, look, he consolidated towards the high side. He corrects and he hits railroad tracks to the 50, and he rises. See that? Okay, then he hits the high of the day, comes back in the consolidation, hits the stops, rise, level 3. Day 1, day 2, day 3. 3-day cycle. The dealer then hits the stops high and traps. Coming out of London the next day, there's your straightaway back into the range. And if you take this number divided by this number, you're almost to the mid-level. Okay, give or take a few bucks or pips. So if you take the weekly range, divide by 2, you will have your corrective measure or counter move against the trend where the dealer should go back into consolidation and reevaluate and see what he's got. When the dealer goes to take back his money, he will come back in the middle of the range. And it just so happens that he went pins of the mayo. He went right into the middle of the mayonnaise there, if you notice. This is what I mean, pins to the mayo, and I'll teach that. Okay. All right. This should piss you off. The consolidation zone created during these moves are used to create false support and resistance level that's visible on the chart. What do I mean by that? Okay, I showed you that the dealer makes his anchor point, right? And then he goes into consolidation. Goes up here, goes into consolidation, goes into consolidation, right? Those are parts of the structure. Now, sometimes these structures are mid-level, sometimes they're a little higher, a little lower. What those bastards are doing is they're going into consolidation somewhere that lines up with some other consolidation period. And when you draw the line and say, oh, Steve, this is support here from 1907, or this is resistance over here from 6.5 months ago, and the dealer's going to bounce off that and correct. He's making you draw that bullshit because he's going into consolidation, ending his day and balancing his book and going back into circular trading right at that area where he knows people are drawing the lines. So that's why support and resistance, like I told you in the sales conference, is garbage. Because the dealer knows where people are drawing the lines, and he ends the cycle right in that area. And then the market, because it's absent of market maker support, goes into sideways movement right on the support or resistance line. And then you come along and go, wow, look at that support point. Dope, draw my line. Oh, this matches up with February, with April, with June, with, oh my goodness, it's all the way out here, right? You start drawing this bullshit, and then the dealer comes up to it, he fakes you to it, and he goes, just kidding. And he kills it. In another organization I was involved in before, when I was learning how to become a mentor, let's leave it at that, I saw a room where they were calling trades. I actually felt bad for everybody. They drew no less than 17 support and resistance points on the chart, and the dealer cut through them like they were butter left out of the fridge with an electric steak knife. And people got killed. It was absolutely a crime to see them do that to people. Some of you know what I'm talking about, some of you don't. Don't worry about it. It's not important. Just know that it's garbage. And this is the reason why. The dealers line up the accumulation phases the consolidation zones to match the support and resistance on the chart to psych you out and to make you draw a line. Okay? Buy third level, sell third level, grab easy profits. Understand at level 1 and level 3, aggressive moves will be seen because that is the anchor point for the trend, the reversal point for the cycle. Market makers have to book a profit. They do it at these levels, at the extremes. They don't have an infinite amount of money. They have a finite amount of money. So they give it out, they give it out, they give it out. Ah, shit, I need some back. They take it. They give it out, they give it out, they give it out. I need some back. They take it. That's why at these levels, they go heavy. The dealer comes heavy at level 3. Dealer comes heavy at level 1. Level 3 becomes level 1. All right, understand? Now, if you're at level 3 and you start a new cycle, right, the dealer hits the stops high, level 3 has become the beginning of the reversal cycle. So now you're looking at stop hunt high, level 1, into consolidation. Level 3 becomes reversal, level 1. Hope that makes sense. Now, a lot of you know what Head and Shoulders is. Maybe you understand what Head and Shoulders is, maybe you don't, but I'm going to explain it to you. The Head and Shoulders develops at level 3. So if you don't know where the hell you are in the cycle, and you're just wandering around the chart, and you notice a Head and Shoulders, hot damn, I'm in level 3. That's what you need to tell yourself. I made it to level 3. Now, a Head and Shoulders is simply the M or W formation where the dealer is hitting the stops, inducing the level. He hits it here, he hits it here, he hits it here. That's like the chart I had up that some of you got offended over, by the way. The dealer hits the low. He comes back and hits the stops of the traders that got in here. The stops are here. He makes one more pass to validate the extensions and the fibs, and then he corrects out of that area. If you deal the Head and Shoulders from the neckline, you're too late, my friends. You deal Head and Shoulders from the low or from the second leg W or M formation. That's what it is in essence. Right? In essence, that's what it is. You deal from here or from here. Dealing from the neckline is late. Okay? Okay. All right. I mentioned this too. I didn't say it, but at level 1 and level 3, they're aggressive moves. They call that risk appetite. That's when risk appetite comes in and hangs out with you guys. All right, here you go. You have your 3 levels of drop. You're in level 3. The dealer traps short, pulls back, hits the stops of anybody that was long. And this could either be the shoulder or this could be the shoulder, depending on your take. But in essence, if you get rid of all this garbage, you simply have a nice W formation right there. Okay? The dealer comes back one more time, confirmed here or confirmed here. Okay, see it? Guarantee this is level 3 because the Head and Shoulders presented. And what it is a confusing move to try to fake out the traders and make them take the wrong positions by showing the head is merely an aggressive spike past the low, and then he pulls it right back. Remember I told you, the dealer will cut or extend the low and come right back above it. Okay? Here's the low. The dealer extended the low and came right back above it in 15 minutes. If the dealer comes back above the low or back below the high, his intentions are, in this example, to rise. If he comes back below the high, his intentions are to correct. What did I say a few slides ago? The entire business is based on how the dealer handles the high and how the dealer handles the low. If the dealer takes the Asian range, stop hunts below it, comes back above the Asian range, the move for the session will be a rise. Okay? All right, here's a blow up. Shoulder, induce, hit the stops, induce more, validate this pattern this way. Jam the traders. Okay, this is my favorite saying for Lou. Never trade against peak formation coming out of level 1 consolidation. It is a sucker's trade. The straightaway trade develops here most often. Market makers have their margin window up. They have traders trapped. They got what they need. They may or may not issue a visible stop hunt. Do not trade. Here's what I mean. Peak formation low, level 1 consolidation. Do not take short trades back towards the peak. The appropriate trade is if the dealer comes low, you take him back long. The dealer comes low and issues a signal, you go long. Never trade against the peak formation as the first move coming out of level 1 consolidation. The straightaway trade develops here most often and is a sucker's play. Now, why is that even an issue, Steve? Here's why it's an issue. Because the dealer makes the peak, he goes into consolidation, and because he widens the swing to pick up the breakout traders, he might do it like this. You go, holy shit, that's an M, I gotta take it. You take that M back towards the peak, and the dealer does the M and turns it over and takes you out. And then I get a flurry of emails saying, M's don't work, you suck. Then I analyze the chart and realize you traded back towards the peak formation low coming out of level 1 consolidation. Don't go against, listen, don't bet against the dealer. All right? In line with the dealer. In line with the dealer. Okay, now, we're almost done. I know we're wrapping it up here. We're almost done. Don't confuse 3 swipes at the stop loss levels with the 3 levels of correction of rise, okay? When I explain the stop loss to you with a vector like this and work the stops, that is not the same thing as 3 levels of intraday price movement. The 3 levels of intraday price movement will comprise the entire ADR. The stop hunt will be comprised of 25 to 50 pips on average. Okay? Don't confuse the two. It's very important to go, oh man, I saw 3 levels of drop. And you're talking about the stop hunt. Okay? All right. Once you understand how the market is structured, there's only 4 trades that you should be looking for. When you understand these trades correctly, they are 90% accurate and will not fail. Some new guys that have turned the corner, 5 for 5 this week. My eye doctor in Orlando, I don't know if he wants me to say his name or not, but he's been on a tear. Someone else just turned the corner. A young guy, I'm very proud of him. He's nailing down 150 to 200 standard lots per trade. And I'm working on garnering an interview with him. I'll let you guys know if that develops, and it'll be in the boot camp. Young guy. He now has the world at his fingertips. The world is his oyster. Mastering the setups will ensure your success and produce returns and win rates that are unprecedented in the business. If you tell somebody outside of this session, they're going to say that guy's berserk. You cannot go 5 for 5 in the business. You can't have an entire month of August without a loss, Casey. It can't be done. Guy's crazy. He ought to be put in a white jacket and locked in a padded room. There's no way that could be true about the markets. Market makers don't lose. Why do you have to lose? Now, I'm not trying to set your expectations ridiculously high. But I'm trying to make you understand that if you can decipher what I am teaching you and understand it clearly and see the chart for what it is, and then the hardest part, have the discipline and wait for it to appear. Kevin just told me he's 11 for 12, 31% increase on his account in 1 week. Thank you. once you understand and have the discipline to execute, once you realize that there'll be a new high tomorrow, there'll be a new low tomorrow, I don't need to chase garbage and force crap. Garbage trades, burn my equity on shit. Once you can master that, you own this business. Okay? Here's the 4 trades. Stop, hunt high, drop, M formation. Stop, hunt low, rise, a W formation. Straightaway rise, where the dealer comes out of level 1 and makes a straight exit out of the area. Or a straightaway drop, where again the dealer exits the area quickly to finish the traders that are in margin trouble. If you understand and can recognize these 4 trades, if you have enough sense to stay away from the straightaways, if you can't identify them, and only search for M and W or the right part of the cycle, like my friend in Tampa, you got it. And that's what I'm advocating. The dealer is going to display or show certain behaviors on a regular basis. You wait for the dealer, you stalk the dealer to make this behavior, and when he pounces on the retail traders, you pounce on him. And that's how you have success in the business. Okay? Okay, so what are the trades? MW, a 33.22, a 333, and a multi-session M or W. These are all variations on MW and straightaways. Even during aggressive moves, the dealer will present opportunities. Steve, Euro's been dropping for 5 days in a row. I know. Steve, GBP's been rising for the last 6 years. I know. But candles aren't stacked on top of each other. The dealer didn't come in and go like this and go, whoop, gotcha. That's not what happened. Is it? Because if I want to see that chart, there is corrective moves against the overall trend, always. Okay? They might not be visible to the untrained eye, but when you start to see it, you'll realize that the dealer has to swing the market. It's what they do. He'll present the opportunities laced with inside of the big corrections or rise that correspond with higher targets issues to the dealers that have to be met to appease the global issues, the families, the World Bank, the bigger targets. These times will still display stop hunts and formations that can be traded. You have to understand where you are in the cycle at all times. Walk up to a chart, analyze the higher time frame, and see, man, GBP is approaching the yearly low. What do I expect here? I expect it to form a W and extend, or I expect them to break that yearly low, induce a bunch of traders to take it, and then possibly return. These are the questions you have to ask yourself and see where you are in the cycle. Okay? Alright, so now, second leg, the dealer vectors to the stop hunt zone about 26 pips. He pulls back. Second leg, this happens in the shadow at the changeover, that's okay. He makes the M formation. He then shifts the zone away from higher level longs. They are now trapped. He then fakes at the moving averages by hitting the stops, hitting the stops, hitting the stops, hitting the stops, and then he shifts the zone away from those guys again. You see how the cycle repeats itself, but in micro bursts or in bigger sections or in daily sections or in weekly sections. The dealer makes a big fat M. In essence, you could say this is an M, couldn't you? He shifts the zone away, then he hits the stops again and corrects. This is a simple M trade. This is a simple W trade where the dealer has extended the low on the second leg but came right back above. This would be a perfect time to enter this trade on the close of that hammer. How do you know? The dealer has made an extended move past what was the low of the day, and within 15 minutes he has come back above. Okay, someone posted for me, month of May, 21 wins, 2 losses. So far in June, 3 for 3. Congratulations, my friend. Okay. Understand? The hammer is issued. How do you know this is a good trade, Steve? The dealer established the low. He worked it for how long? Here's the low. 1, 2, 3, 4, 5, 6, 7, 8. 2 hours, right? Then what happens? The dealer at the session changeover spikes the low and comes back above and issues a hammer going into the Brink's time shadow. We know the session changeover is coming. The dealer has already made his 3 levels of drop. We expect him to go back at least to the watermark. Okay? 33 trade. 33 trade is a trade where on the 3rd day of the cycle, the dealer will issue 3 intraday levels. Okay, let me say it again. On the 3rd day of the cycle, the dealer will extend it by 3 intraday levels. So you have a 3rd day, 3, and 3 intraday levels, another 3, a 33 trade. What does it mean? The aggressive move by the dealer on the last leg of the cycle is to induce traders to show what they call trend acceleration and to get everybody excited to go long or short. Okay, what happens? You start to get separation from the moving averages, you get excited, and on the last leg, you have day 1 rise, day 2 rise, day 3. You have 3 levels of rise to induce traders to chase. Okay? That's a 33 trade. A 333 trade is this. The last leg of the last leg is a stop hunt that contains 3 vector candles. Okay? This is what I'm talking about on the 333, the last section. See how the dealer makes his last ditch effort to induce traders to go short? He does it in 3 candles. The trend is down. It's been down for a couple days because you have beautiful angle and separation on the averages. The dealer has extended price. In the last leg of the last leg, the 33 part of it, the dealer has the 3rd day he's made 3 levels. And on the very last segment of that leg, he makes 3 vector candles as a stop hunt. Induce the last batch of traders to take it short. And then he's like, I was just kidding around with you guys. Takes it back. Okay? 333 to the upside, same thing. The last batch, 2, 3, where the dealer makes 3 aggressive moves towards the last high as a stop hunt, and he corrects. Angle and separation, it's been moving for a few days in the upward motion. Okay, 22 trade. The dealer makes a second leg of a second leg M or W formation where he goes near the level and fails to break it, or goes slightly above the level and comes back below. This is a multi-session M or multi-session W. The dealer has made the high in the U.S. session and has come near the high of the session in the next U.S. session. Okay, 1 to the downside. Boom. Second leg of a second leg on a quarter wood. Okay? All right, here we go. End of the night. Go home. Pick a chart, pick a pair, anything you want, and label the chart with everything you can think of that I discussed tonight. If you're tired, don't do it tonight. Do it tomorrow. But here's the deal. I want you to do it because I want you to lock in and solidify everything that I have taught you tonight. I want you to be very detailed. I want to see Asian ranges. I want to see peak formations. I want you to go through and explain everything that I've discussed since the beginning of class tonight. All 4 hours and 10 minutes of it, whatever it is. I usually use this test chart, but a lot of you don't know how to do a screen capture. If you want to screen capture that one, go ahead and mark this chart. If not, if you can't screen capture, don't know what you're doing, don't have Jing or a Screen Hunter, then go ahead and pick out your own chart and mark it. I want you just to hold on to the chart. Don't email it to me. We're going to go over the answers tomorrow. Okay? So with that, we'll wrap it up. Here's what we're going to do. Tomorrow, we're going to come in, 6 o'clock, be prompt. I'll be on time. We're going to answer the quiz questions. You should have most of those answered. We're going to look at this chart, this test chart, to see what you locked in. We'll review and then we'll move on for the next section. Okay?